So, Todd, thank you for being with us today. What do you see as the biggest challenges or the greatest threats that could destabilize the U.S. economy?
Well, we're on the edge of a trade war at this moment. President Trump and the leaders of Canada, Mexico, Europe, and China are not getting along very well. The U.S. economy is growing at a very fast pace at the moment, but that depends on being able to buy and sell goods from abroad.
And the events of the last week, has that made you more convinced that we could be in a trade war?
Well, I think we're very close to a trade war, and it's difficult to see how exactly leaders pull back at this moment. And I think the farm community in the U.S. in particular is subject because about a third of our soybean crop goes to China. China knows that farmers are voters. Republicans know that farmers are voters, and they'll be knocking on the doors of the White House asking whether President Trump really wants to get reelected or not. So politics in the U.S. may intervene, and therefore we might avert this trade war.
Okay. What other sectors do you think might be particularly impacted by a trade war?
We have already imposed tariffs on steel and aluminum. So the automobile industry is subject to that. Makers of refrigerators and freezers and dishwashers and toy cars are subject to that as well. And that means it drives up prices and it reduces opportunities to the extent our trade partners retaliate.
Okay. Do you foresee another global slowdown, a crisis of some kind?
The global economy is doing okay at the moment. Earlier this year, it appeared that almost all major economies were roaring on 8 cylinders. Well, now it looks like the U.S. may be on 8 cylinders. Europe has fallen back to 5.5 cylinders, and Japan may be at 3 cylinders if they can make a 3-cylinder engine in Japan. So the global economy is good enough to sustain itself if it's not destabilized by either higher oil prices or by a trade war.
Okay. Where do you see oil prices going in the near future?
Oil prices could very well go a bit higher, but there's a lot of oil that is offline. When the price of oil collapsed from $100 to $50 in 2014 and 15, many oil wells were capped. They were taken offline because they weren't profitable. Well, now that the price of oil has moved back into the mid-60s, those oil wells are going to be producing again. So I suspect that if we were to meet a year from now, we would not see oil prices significantly higher than they are today.
Okay. So we're now in our 9th year of a record bull run, and a lot of people have speculated on when that might end. What's your prediction?
The bull run in equities is related to interest rates. Interest rates are still remarkably low. The U.S. 10-year Treasury is 2.95%. Bank CDs pay a paltry return. So where else are people going to put their money except in equities or possibly in real estate? So the real question is, will interest rates stay at this quite low level? My best guess is that inflation is behaving, which means interest rates can stay rather quiet, which means the equity markets will be beneficiaries.
Okay. So we've seen the rise of populism and extremism around the world, Europe, Asia, Africa, here in the West. What does the rise of populism and political extremism say about developed nations?
Well, the rise of populism has to do partly with globalization. It has to do with cheap foreign goods and with middle-class workers feeling as if they're losing job opportunities, but then it also has to do with immigration. And the U.S. has had a rather porous border, and Europe has had a porous border. And I think leaders like Angela Merkel of Germany are currently paying a political price because their view towards refugees and towards immigration didn't seem to take into account the negative impacts on domestic voters. So I think politicians are going to need to recognize that perhaps they shouldn't swing towards an extreme nationalism, but they need to understand that their primary loyalty does have to be to their citizenry when they're making those sorts of decisions.
Okay. Given all of that, what do you think private equity firms should be doing at this point?
I think private equity firms need to be looking for the best opportunities. Now, those opportunities at this moment do not seem to be in areas where trade wars can withdraw support. But I think private equity also needs to be looking at which companies, which targets might be more interest rate sensitive. My best guess is interest rates aren't going higher. But if you're allocating capital for the long term, I suspect interest rates will be higher if we're looking 3 or 4 years from now. And so I think private equity firms need to be very wary of those firms that have been beneficiaries of super low interest rates, but will not be beneficiaries or will be losers in an environment where rates go up, which they're likely to do sometime starting 2 or 3 years from now.
Okay, great. Well, Todd, thank you very much for your time.
Pleasure.